This video is brought to you by TogetherBudget.com. Welcome back to Mastering Retirement Accounts. Today, we're diving into the basics of retirement accounts. Let's start with the types of accounts available.
That's right. So, what are the main types of retirement accounts?
Let's take a closer look at 401k plans. What are some key eligibility requirements for these plans?
That's a great question. Typically, employers sponsor 401k plans and determine the eligibility criteria for employees.
Now, let's discuss IRAs. Who is eligible for an IRA?
That's a great follow-up question. Anyone with earned income can contribute to an IRA.
Let's dive into the employer matching portion of a 401k plan. Essentially, when you contribute to your employer-sponsored 401k, many companies will match a certain percentage of what you put in.
That's right. For example, if an employee contributes 5% of their salary to the 401k, and the company matches that amount at 100%, then the total contribution is 10% of their salary.
Exactly. This employer matching can be a significant incentive for employees to participate in the plan, as it essentially means free money being added to their retirement account.
Absolutely. And it's also worth noting that some companies may have vesting periods, which means you don't own the employer match immediately. You might need to work for the company for a certain number of years before the match becomes fully yours.
That's right. It's essential to review your company's 401k plan documents to understand their specific vesting period and matching rules.
Now, let's talk about contribution limits. The IRS sets annual limits on how much employees can contribute to their 401k plans.
That's correct. For the 2022 tax year, the elective deferral limit is $19,500, and an additional $6,500 catch-up contribution for those aged 50 or older.
It's essential to keep track of these limits and adjust your contributions accordingly. Otherwise, you might face penalties for exceeding the maximum allowed amount.
Exactly. And it's also worth noting that some 401k plans may have their own contribution limits or restrictions, so it's crucial to check with your HR representative or plan documents.
Definitely. You want to make sure you're taking advantage of the plan while staying within the IRS guidelines.
Now, let's discuss investment options. When it comes to 401k plans, you'll typically see a range of investment choices, from stocks and bonds to mutual funds and target date funds.
That's right. The investment options will vary depending on the plan, but most employers offer a mix of low-risk investments for conservative investors and higher-risk investments for more aggressive ones.
It's essential to review your investment choices carefully and consider your personal risk tolerance, retirement goals, and time horizon when selecting your investments.
Absolutely. And don't be afraid to ask questions or seek guidance from a financial advisor if you're unsure about any of the options. Remember, this is your money, and it's crucial to make informed decisions about how it's invested.
When it comes to retirement accounts, one of the most fundamental decisions is whether to opt for a traditional or Roth individual retirement account IRA. The main difference between the two lies in how contributions are taxed and when you'll pay taxes on withdrawals.
That's right. With a traditional IRA, contributions are tax-deductible, meaning you can lower your taxable income by putting money into the account. However, when you withdraw funds in retirement, they're considered ordinary income and taxed accordingly.
Exactly. On the other hand, Roth IRAs have no tax deductions for contributions, but withdrawals are tax-free if certain conditions are met.
That's a key point. So, it really depends on your current financial situation and what you anticipate in retirement. Do you think we should highlight some scenarios where one might be more beneficial than the other? Now, let's talk about contribution limits. What are the annual IRA contribution limits, and how do they change over time?
The IRS sets annual contribution limits for both traditional and Roth IRAs. For 2023, the limit is $6,000, or $7,000 if you're 50 or older due to catch-up contributions.
That's a good reminder. And what about phase-out ranges? Those can affect who's eligible for full deductions.
Phase-out ranges do come into play, especially for high-income earners. If you're single and file as head of household, the phase-out range is $68,000 to $78,000 for 2023.
I see. So, it's not just about hitting the contribution limit but also being aware of these phase-outs.
Let's dive deeper into the tax benefits. What are some of the key advantages of having an IRA?
One major advantage is the ability to delay taxes on your contributions and growth until retirement, when you're likely in a lower tax bracket.
That's right. And with a Roth IRA, you've already paid income tax on your contributions, so withdrawals are tax-free in retirement.
In addition to these benefits, IRAs also offer some protection from creditors and bankruptcy.
That's an important point. It's worth considering the overall financial landscape when deciding how much to contribute and where to put your retirement savings. So, let's talk about converting a traditional IRA to a Roth IRA. This can be a great strategy for some people, but it's not without its implications.
That's right. What are the benefits of doing this conversion?
Now, let's talk about the withdrawal rules for Roth IRAs. What are some key things to keep in mind?
Yes. Can you explain the 5-year rule and how it affects withdrawals?
One of the biggest tax implications of converting to a Roth IRA is that it's considered taxable income.
That's right. How can people minimize their taxes when doing this conversion?
Let's talk about catch-up contributions. For those who are 50 or older, there's an opportunity to contribute more to their retirement accounts.
That's right. And it's a great strategy for maximizing savings. Can you explain the details?
Another strategy is loan provisions. Some plans allow participants to borrow from their accounts, but this can be a double-edged sword.
That's true. Borrowing from your retirement account can provide liquidity, but it also means you're taking money out of your future self-savings. Can you elaborate on the risks?
Required minimum distributions (RMDs) are another critical aspect to consider. They're essentially withdrawals from your account that start at age 72.
That's right. And it's essential to understand the rules surrounding RMDs, as they can impact tax strategy and retirement income planning. Can you walk us through the process?
This tutorial is brought to you by Malik Abwalzait.